प्रेजेंटेड बाय ईबिक्स कैश, हर खुशी के लिए काफी है।
Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is my co-host Abha Bakaya, and joining us today as market expert is Nirmal Jain, founder and chairman of the IIFL Group. Nirmal is not only the head of and the founder of one of India's largest non-banking finance groups, but he's also a pioneer of sorts in the equity research business, having been at it for almost 30 years now. Nirmal, it's good to see you on the show as always.
Thank you, Udayan. Good to see you.
And I want to begin by asking you about what everybody's talking about now, which is basically these large digital IPOs which are happening. Paytm, Nykaa. Well, Nykaa's listing was great. Paytm subscription numbers were a little lukewarm. Do you sense that it is possible that one of these big IPO listings, big billing IPO listings, might actually not end up creating money for shareholders, and that could dent sentiment? I mean, it has happened in the past when some of these big IPOs actually backfire a bit. Is that risk present in the market today with the way the Paytm subscriptions went?
No, the risk is there for sure, but when and how this will happen is very difficult to forecast. So today, if you really look at it, then there are foreign investors who are putting money on these kind of IPOs. So if you see, they've been selling stocks like maybe HDFC and Kotak banks and buying into these kind of IPOs. And if you look at their mindset, then what has happened in the last 10 years, they made an enormous amount of money in these kind of stocks in China. So whether it's Tencent or Alibaba, when they invested, it obviously looked horrendous in terms of valuations, with no justification by traditional yardsticks. But these investors, some of the large foreign funds, they invested and they made money, and they made a lot of money. And now, as we know that China is slowing down, also the lots of things, they are not going right there for investors, and they are looking that probably India in next decade will repeat the story. So what they are betting on is a strong growth momentum to continue, and a monopolistic or a duopolistic kind of position that some of these companies have will basically help them make enormous amount of money. But jury is out. It's very difficult to say. And I know, in fact, historically, we know the Reliance Power IPO had come, and that basically turned the market. Whether something similar will happen or not is very difficult to say. And even if it happens, it's very difficult to say it will happen in 1 month, 2 months, 2 years, or 3 years. But all of us know that these kind of valuations for these many stocks cannot sustain forever.
I want your perspective specifically, Nirmal, on the Paytm particularly, without commenting specifically on the name, because you have the unique advantage of not just being a pioneer in equity research, but running an NBFC yourself. And we were speaking to Sanjeev Bajaj the other day, and he said, these guys will struggle to make money because there's only so much money you can make in distribution. They don't manufacture any of these products. Do you subscribe to that line of thinking? And do you think the market is overestimating the potential of some of these fintechs?
Okay, let's not talk about Paytm, but the payment companies. So all the payment companies, or payment-focused, technology companies, if you look at their prospectus, if you look at the investor pitch, all of them basically, plan to make money by lending, because they know that there's not much money in payment. So payment will be loss-making proposition, but they think that they will have transaction data. They'll have rich, verified transaction payment data of the customers, which they can leverage and probably make money by lending. Now, that is where the question is that lending, at least the way we understand, as we have been doing this for more than 1.5 decades, is a long learning curve business. It's not something where you can create something in the lab and just roll it out in the market. So again, it depends on how historically what has happened. Udayan, is very difficult to do any crystal ball gauging in this, because there are many companies that raise money, the market remains benign, they raise more money, which allows them to learn, which allows them to invest in the market or learn by mistakes, as well as keep growing. So today you can't take a call, but I also share the sentiment that it's not easy to make this kind of money in lending, which justifies large valuations. But then lending is one part of it. They are basically many of these companies are plan to get into all financial services, segments, and in many of these segments we compete. So I don't want to sound on a public forum as if I'm biased, but obviously it's a very competitive world, and to incumbent players like us, we have competition from variety of new players, and we have to be, we have to be watchful. आवाज आ रही? Yeah, we have to be a
But
little
let's
watchful.
forget about fintechs or payment companies. Let's forget about fintechs for a moment. Let's take the bias out of the equation. You just said something very interesting, which is that people are selling, foreign investors are selling HDFC Bank and Kotaks and are buying into the Nykas and Paytms. What would you do as an investor? Because you've seen many cycles. Does this seem like a prudent strategy to you? Would you sell some of these blue chips, traditional blue chips, and get into the digital unicorns if you had money to run now?
I won't do that, Udayan, because I know that maybe I'm a little traditional in terms of mindset. So I won't do that. So what happens that you always will have a fear of missing out and being left out. What you can do is that put about 10% of your money of your equity allocation into these kind of stocks and just forget about it. But if you ask me that whether I'm going to sell my blue chip and buy these stocks significantly in my portfolio, answer is no. And even for me, probably I have a little larger risk appetite, and that's why I'm saying 10% of my equity portfolio. But most of our clients, we won't even advise that much. But there are a number of traders and speculators who want to play on a momentum or on a swing trades or a day trading. They trade in these kind of stocks. So there's flavor of the season, and you just can't, you can't basically go against it too much.
Okay. Nirmal, in light of the kind of retail resurgence that we're seeing in the market and the kind of momentum, what are you seeing as an opportunity in terms of offerings for retail investors, and how would you guide them in approaching the market like this?
So one, the recovery in the economy is for sure. I mean, that we can see that economic recovery is happening. And there are a number of reasons for this, because pent-up demand, government has infused huge amount of money into the system. But besides, very good digital infrastructure has been created in India with the lowest prices for data. And then you have your identity by Aadhaar payment system, which has been, is probably one of the best in the world in terms of the digital advancement. And these are the things which are happening in many of the new digital companies, and also helping many of the existing companies to reduce the cost, improve their productivity. And also, if you see that there are many new sectors that have come to the market, markets have broadened, which is also allowing many new investors to come in. That also I'll talk about in a minute. But in terms of economy, exports are also doing well. Tech sector is doing well. The GST has stabilized. 15% tax on new manufacturing units is also helping. PLI scheme also is taking off. So all these things indicate that the Indian economy seems to be rebounding and probably will have next 2 to 3 years as good years. Then in terms of investors, the ease of investing and the lowest cost of investing, and new millennials that are educated, they can probably understand, they're comfortable doing their homework on their own. And a huge number of them have come to the market. And to some extent, or maybe to a large extent, they have reduced the sensitivity or vulnerability of the market to FIs or FPIs. And as we have seen that in the recent past, when foreign investors or foreign institutional investors have been sellers, a number of individual investors have absorbed those selling, and probably the market has sustained itself. And this has happened not in India but many other countries. So in COVID, I think this trend has picked up, which was driven by many things. People had more savings as they were not spending much. They were at home more time. But most importantly, the technology made it very easy and very cheap for people to invest and trade. So this is how the market is shaping up now.
The kind of recovery in the economy that you're talking about, Nirmal, the question is how much is the market priced in already? Because we see a lot of brokerage reports which are coming out saying, we've had a great run in the market, but prepare yourself for weak returns or no returns in 2022. Do you think that could happen, that the market may need time at some point to digest its gains because some of the good news is already in the price today?
Yeah, but if the underlying momentum is strong, what will happen? You will see what we normally refer to as time correction. That market consolidates in a narrow range for quite some time. So maybe 6 months, 12 months. But in my opinion, what is happening that the valuations will have a new normal, which is at a higher level, primarily because interest rates are low. A lot of money that has flowed in, after any crisis, if you see like 98 or even 2007 global financial crisis, when most of the central banks pump in a lot of money, then that rally continues for 3 to 4 years because there's a cascading impact. What is happening in India, at least, we are seeing the private sector capex is recovering, and you are seeing that is bouncing back for the first time. And what happens in capex that the commodity companies basically they can do large ticket capex. So if you look at companies which are in consumer or services, their capex requirement will be very small. But if a steel company or a cement company is setting up a plant, it will be large ticket investment, and that will have a cascading impact on the demand for many products that are used for steel, cement, plant and machinery, labor, and that money basically circulates in the economy. So then, if the economy growth sustains for 3 to 4 years, there might be intermittent corrections, but still there'll be opportunities. And I think what will happen, there'll still be opportunities for growth stocks. The market rally has been very strong in some sectors and some of the stocks, but people will keep discovering. If you look at earnings forecast of most of the brokerages, okay, let's look at the Q2 results. The 2-year CAGR has been just about 28% for Nifty stocks, but has been almost 50% for BSE 500 stocks. So what we are seeing is that the mid-cap and small caps, maybe because they were far more depressed due to liquidity crisis and COVID, they bounced back very strongly. And even the earnings estimate of most of the analysts show that mid-cap and small cap probably will have a stronger movement. And that is what we need to see. Having said that, there is always a caution about inflation because the commodity prices are rising. And now again, what is happening? If you see auto ancillaries, then they have seen the margin dip. But then there are companies like Asian Paints. They had one quarter which was impacted by raw material. They took a price increase of almost as much as 10%, and they have a pricing power. And the next quarter they're bouncing back. So there'll be all kind of companies and the sectors. But inflation is something which probably one needs to be more watchful than probably market has not taken a serious note of it still.
That's an interesting point, Nirmal, because there is a feeling in certain quarters that we are underestimating inflation, and maybe even in the first quarter of calendar 2022, we could see the rise of interest rates once again. Are you saying that the market is probably not pricing in that risk today?
Market is not pricing in, but maybe let me first say what market is thinking, and then we can discuss how do we analyze that. So in the US, inflation has been almost at 30-year high. But many people say that this is because of supply bottlenecks. And as soon as supply bottlenecks are removed, probably the inflation will taper off. And also they think that the interest rate increase will not be very quick because, the Fed as well as the policymakers there will say that let's wait for some time. We are just recovering from COVID. Let's not take risks with that kind of growth. People have seen the taper tantrum earlier when it happened, and how it can spook the market and what kind of impact it can have on the economy. So I have a feeling that interest rate increase, if the inflation continues at a higher level, sooner or later it has to come. But it might happen by the mid-2022. So maybe it will wait for another couple of quarters because people will still watch whether this inflation is sticky or it cools off on its own.
Nirmal, I want to know what some of these newest sectors are that you're looking at as well. Would there be sub-sectors you feel, or are you looking at something else thematically?
So I think, if you have to look at investing, then probably one should look at a more balanced portfolio rather than these new age sectors and companies. If there's there are known unknowns, which are two things, which is the China slowdown and what impact it will have on the commodities. And the second is US inflation. So these are two unknowns which are known to us. But there are always, we have seen that there are some unknowns, which probably you and I don't know today, and that can happen. And if there's any accident, any crisis, then already all the global large economies have printed so much of money that they won't have any ability to do something more, because already deficit is running so high that it's very difficult for anybody to handle another crisis. So if the correction has to happen, then these new age sectors will have very high beta and probably will be the worst hit to my mind.
Okay.
And then the second can be the commodity stocks in the China slowdown. Now, China is always a black box. People talked about Evergrande, but after the grace period, they started paying. Nobody knows where they're getting money from. So what will happen to China is very, very difficult to predict. But if China slows down in a significant way, then it will have an impact on commodities, and that will have an impact on many sectors and many stocks.
These are known unknowns, Nirmal, and as we know that known unknowns usually don't trigger massive corrections in the market. What is, in your book, the more likely unknown unknowns? What could cause an accident? Do you think something could come and surprise the market from a field like the cryptocurrency field? I mean, could something, a meltdown happen there which percolates across to the equity markets and economy at large? Do you think about these things, where the accident might come from?
Yeah, actually, accident may come from a geopolitical, because the way China is, politically, the way the country is shaping up, and given the fact the economy is slowing down there, so there's always a risk that anything can trigger a war and anybody can get involved. So that is one risk. But other than that, even crypto you mentioned, which is interesting because new money is being created by some formula which is still not tested. Historically, we have seen that money is always backed by some solid assets, because otherwise it can cause inflationary pressures. Still, crypto is not regulated world over. The size of crypto assets has become very, very large. Even in India, I saw an ad. There's something like 6 lakh crore of crypto assets exist, and still regulators are not up to speed with this. So this is something which is completely, and you can't have a currency which is so volatile that 100 becomes 60, 60 becomes 120. So it's not currency yet. I won't really. So I think that crypto is a serious risk because many more currencies are coming in. We don't know what kind of money is being created, and it's become very speculative. So what has happened in India also? With 100 rupees, you can open a crypto. You can start trading crypto, and you make money then speculative, because the young generation who's they get caught by it and they start putting in more and more money. And we have seen this in the past that, that is never so easy to make money. And when money is coming so easily, then obviously, that it's going to be, get wiped out, and it will come to grief, at some day. So I think there's a big risk to the global economy. Nobody knows, because there's no precedence that how this will pan out. But one thing we know for sure, that this kind of mania and this kind of growth can't sustain.
I want to ask you to wear your NBFC hat for a second and tell us more about this Capex revival that you spoke about. Because in reality, in India, we haven't had a serious Capex boom or a cycle since 2007. The last one, I think, ended around 2008. From your perch, how confident are you that this Capex cycle is for real? And how would you therefore tailor portfolios, individual portfolios? Should one forget about these old consumer kind of companies which have created wealth over the last 10 years and switch now to Capex plays which have not delivered for the last 10 years?
So it's very interesting. Now, commodities, new capacity has not been created in India and in world over also for a very long time. And the profitability, as we have seen, the steel companies or even other commodities like aluminum, zinc, can swing very, very in a very leveraged manner. So I think the Capex cycle revival is happening for 2-3 reasons. One is that the cash flow and the profitability for these companies, so take for instance companies like steel company like Tisco or SAIL, has been so strong that they've been able to repay their loans, and now they are having cash flow to take up expansion through internal accruals with very limited debt. Now, this kind of scenario we've not seen in the past. So obviously they'll feel a lot more confident because they've been able to repay their debt ahead of time, significant part of it. And they have internal accruals, which at least at this point in time seem very good to provide equity for expansion. So Capex revival is happening for sure. Other than that, government is also pumping in a lot of money into infra, and directly as well as through partnership model. that will also drive. And when there is an economic growth, which is driven by many things, including what investment government is making, pent-up demand or whatever, then I think for a long time, for 14 years, as you said, we haven't seen the capex. It was pent up, it was long overdue, is happening. Is happening for sure, at least in Indian context. And even elsewhere also, many governments are driving this because they know that this may be more sustainable job creation rather than just putting money into people's bank account, because that might not last too long. So I'm quite optimistic on capex. Secondly, coming to our NBFC, we are not into project financing or capex at all. So we are primarily only retail, and home loan, affordable home loan is one large segment that we address to, and we have seen very strong revival there in demand. We also seen a very good recovery in the collection efficiency also. And in real estate, residential, at least in Indian context, we have seen that the demand recovery is very strong. So many builders, many developers, they're struggling, are seeing that sales are taking off. Many of them, the smarter ones, have reduced the prices a little bit to make sure there's a cash flow continues. And the revival is all over. So earlier it seemed like in some segments like luxury pockets in Bombay or maybe some affordable segment. But what we are seeing that the demand for residential apartments and the units all over the country is reviving. And that is being helped by two, three things. One is interest rates are low and mortgage demand is very sensitive to interest rate. Two, the developers and builders have reduced the prices, and for last 4 or 5 years, they have not increased the prices, and some of them have taken a price cut also. And also in the lower segment, in the affordable segment, PMAY subsidy scheme, which is Prime Minister Awas Yojana, has worked very well. Government gives subsidy by direct credit to lender, and lender basically reduces the principal loan amount of the borrower and the EMI thereby. And that scheme has worked very well. In the last 50, 60 years, all the housing incentive schemes were based on tax concessions. They never worked because most of the people in the affordable segment, they don't file tax return or they don't have any taxable income. And therefore, the subsidy scheme has worked well. Then other products that we do is gold loan. What we have seen that after COVID, many MSMEs, they have a working capital requirement because they are seeing business revival. So that demand also is growing. And business loan also is like linked to that. There also we are seeing a good recovery. One segment, which is microfinance, struggled a lot. That had a huge amount of delinquencies because of COVID, and more so with the COVID second wave last quarter. But we are seeing recovery this quarter, and hopefully that momentum should sustain. So, in NBFC retail business, there's a very strong revival of the demand as well as improvement in collection efficiency. Some of the NBFCs have shut down or wound up. That is also helping in terms of market because on the supply side, there's a consolidation. So that is also good for the market.
Nirmal, we are out of time today, but thank you very much for your time.
Thank you so
Always
much.
great to hear your thoughts. That's Nirmal Jain of IIFL, and we shall return next Monday with another voice from the market as always. Till then.